All right. Thank you, everybody, for joining us today. We are talking about the short-term rental strategy slash loophole,
Mm.
right? Many of you will probably commonly hear you search this on Google. It's known as the short-term rental loophole, the STR loophole. And so we want to kind of go over what this is, why it's important, who's it for,
Mm.
um, and give you some quick kind of real life tips in how to implement it because there's some nuance there,
Yep.
right? And there's a lot of bad information floating around on TikTok all over the internet about, oh, it's just as easy as 1, 2, 3. And it is, right? As long as you know the rules correctly and you implement them correctly and you document everything correctly, then the IRS has no problems with it. It's not a loophole. It is very legal in the way it's structured. The IRS goes over it in Section 925, and we're going to be going over it with you today.
Yep.
So let's dive into the short-term rental loophole strategy. Okay, so what is it? Let's start there. What is this strategy? What does it entail, Matt?
Right. How does it work?
Yep.
So what we're going to do is, in order to run this strategy, we're going to purchase a property for the intent of running it as a short-term rental.
Yep.
We're gonna place it into service as a short-term rental. We are setting up a business that is a short-term rental business,
Yep.
and that's kind of why this is kind of written in the code the way that it is. Generally, in 925, it says, hey, an exception to what a rental activity is property that's got an average stay, an average period of customer use on that property of 7 days or less. And so this is saying, all right, well, we can do a short-term rental, keep it within that mark, and be considered active income. Keep it on the active side. We talked previous videos about active versus passive income, active versus passive losses. We're keeping this on the active side so that our other W-2 active job is something that we can take a loss from this property on. So in that, we buy the property, we put it into service as a short-term rental. We run a cost segregation study on that property to allow us to take accelerated losses against that in the form of depreciation. And then we take those losses, excess losses from that, because it's front loaded at the front end far enough that we've got excess there beyond just the losses within the business. We take those excess losses against our active income at that point.
Yep.
So if I make $500,000 in whatever profession I'm in, and I have various losses from other things that I do, but running this strategy, let's say I have $200,000 in depreciation losses, I reduce my adjusted gross income from let's say the top end of 500,000 down to 300,000 because I have losses against those income.
Yep. Perfect. And so in essence, right, this strategy, what does it do? It takes something that is normally considered a rental real estate by the eyes of the IRS, which means, hey, that's passive.
Generally
right?
passive.
You can only offset passive income with passive losses unless you're a real estate professional, which we talk about in a different video. What it does is it takes something that's a rental real estate action, right, and it makes it an active business, right? So that's the whole purpose of this is okay, I'm going to buy that house. I'm going to post it on Airbnb, VRBO. I'm going to make this an active business. It's not just like some passive investment thing that I have going on.
Which requires material participation. We're going to get into that as well. And kind of the quirks with that and why this can be a little bit tricky for some people. But the reason that it's considered an active business, not just it's not passive because it's 7 days or less, but it's also an active business for us because we materially participated in that business.
That is the part that the TikTok guy does not tell you. Right? That's where everyone gets into hot water. That's why you see all these lawsuits, people getting an audit, and then they're like, wait, I was told that, but I own a short-term rental. I can take the losses from that property, offset it against my active income. I'm good to go. And no, there's more to it. We've got to go ahead and do the correct things, jump through the right hoops, and have the correct documentation for the IRS to make this actually possible. So it is a real thing, and we're going to dive in exactly what it does and kind of how to do it correctly. But let's go to who is this for? Who is the short-term rental strategy / loophole for, right?
Yeah, that's going to be for somebody who earns a high income and has a tax problem. This might not be for the individual that does not have a tax problem. Maybe your taxable income is in a low tax rate. I'm in one of the lower tax brackets, 10%, 12%, 22% even.
Yep.
The person who benefits the most out of running this strategy, enough to make it worth their while, is the person that's in one of the upper tax brackets, the 32, 34, 37% tax brackets, where if I offset my taxable income by that amount, I get 37% back what I would have been spending to the IRS. I get the option of taking that as a coupon now and applying it towards furthering my investment strategy here in the immediate sense.
Yeah.
Which is great. So somebody with a high income and a tax problem is who this is for. And somebody who has a little bit of extra time and an interest in real estate. It's really pointless if you have no interest in real estate and you're just not thinking this way. You're bad at that portion of it, and you have no time on your hands because you're so busy making that extra money. If that's the case, maybe just make the extra money in the company, pay the tax, do what you can with your CPA for other stuff. If you don't have the time or interest to be in real estate, this might not be for you.
Yeah, this is very much an active business in real estate. So you got to think of this as your side hustle, right? That is what it is by definition. It's an active business, and so you have to treat it like that. Go in with the eye side of that. Go in with the vision of, this is an active business. I'm going to be participating in this. I'm going to be spending time. I'm going to be giving thought to this. I'm going to be setting systems in place. My job is to make this efficient. We're not talking about short-term rentals being better than any other sort of real estate strategy right now. We're just talking about the real estate, the short-term rental loophole strategy, right? We're just talking about why this is powerful for somebody who's a high income earner who doesn't have another way. They're probably not a real estate professional, because if you're a real estate professional, and go back, if you don't, not sure what we're talking about, go back to another video where we do an overview of that. Where we talk about you have other ways of using the depreciation to get it to offset your active income.
All right.
But if you're not a real estate professional and you don't qualify as that, and you're a doctor, lawyer, dentist, or you're just high income sales, right? Whatever you are, you're not a real estate professional. This is your pathway. This is how you use real estate, and you use the losses from real estate to offset active income. This is your way of doing that. Okay. So this is the strategy for you. If you fit that, continue to kind of listen to this video and see what's up. Okay.
Right. So what are the hurdles getting into this? We have this great little plan set up. What are some of the hiccups that people get into?
Yeah. So the two main qualifiers of making sure that you run this strategy correctly is, number one, making sure that your average guest stay at your property or properties is less than 7 days.
What if I have somebody stay there for 10 days?
That's fine. As long as the average, so what you're going to do is, over the time that you've had this property or this year, right? You're going to take the number of days that it's been rented out, not the total number of days. If you've owned it for, a year, you're not taking 365 days. Everybody knows that a short-term rental might, let's just say you had 50% occupancy, right? Let's just say 100, for easy math, 100 days of that year you had guests stay. Now you're just going to go ahead and divide that by the number of guests that you had stay. Right? And that's going to give you the average
25 total guests. So one of them stayed for 2 months and most of them stayed for shorter. A couple of them stayed for a couple of days. But at the end of the day, 25 guests divided into the 100. So 100 divided by 25. The average night stay then is 4 days.
4. Gotcha. Yep. Perfect. So the second thing that you need to make sure, and this is where everyone trips up, this is where people don't know how to document this correctly. This is where people didn't even know that they had to materially participate in their rental, in this property, in this business. That is material participation. So what does that mean? There's multiple ways to prove and to materially participate.
Yeah, and we talked about that in a separate video. There's several different ways. Really, the biggest thing we're going to look at here is the biggest bang for your buck. How short of time can I put into this with the most amount of benefit from it? Not to try and side skirt stuff, but like that's what we're all thinking here. If I'm earning a high income and I'm wanting to do this other thing, I want to maximize my time. Absolutely, your time is valuable. You're going to treat it as valuable. And what does that look like?
Yeah. You're going to spend at minimum 100 hours in that property, right? And it has to be more than anybody else, any other individual. Okay, so very clear. So what does that lead us? Where does that leave us in terms of what to do, right? How do I make sure that I document that correct? And this is where when you get an audit, this is what the IRS does. They say, okay, show us the documentation. Show us that you spent 100 hours and that was more than anybody else.
Yep.
Some people do great and they document their time and they said, wow, hey, I spent 150 hours. I kept a log. I did all those things. That's probably above and beyond most people
Hmm.
who are trying to run this strategy, to be honest. Uh, you need to take that one step further and you need to document, especially if you're trying to hit this minimum qualification of 100 hours and more than anybody else. You need to make sure that you document everybody else's time as well.
Yeah.
Right.
Yeah. Burden proof will ultimately be on you to prove to the IRS, hey, I have spent at least 100 hours and more than anybody else. And so if they say, okay, well, show me your logs or prove that you've spent at least 100 hours.
Yep.
Also, I see you have this property manager. How many hours did they spend? That's the big question. We got to make sure that we're following the rules. Otherwise, this kind of all comes back on us.
Yeah.
We just end up paying the taxes and penalties later.
Yeah. So a lot of people take this information once they learn this and they say, okay, well, shoot, in order for me to run the short-term rental strategy right here, I need to do everything in the property.
Mm.
And that might not necessarily be the case. That might be, for some people, the play, right?
Sure.
Whether you or your spouse or a combination of the two spend a combined total of 100 hours and it's more than everybody else, like whether you're just doing everything. Maybe you're going there and you're cleaning after every single guest and you're handling all the bookings and right? And you're doing all the repairs that need to happen. That might be the play. But if we're trying to be efficient and savvy business owners, that's not the play, right? So we still want to make sure that our time is valuable. And how do we do that correctly? So a lot of the questions that we get from people who already own short-term rentals is like, well, I have a property manager and I have a cleaning crew, and those people take up a pretty good amount of time and materially participating in my properties. How do I outperform them in terms of time spent? And how do I effectively document how much time they're spending? Those are really the two kind of like real world problems and hurdles that you'll face when you're trying to implement this strategy.
Yeah.
So
You hire a property manager and they're going to do they're going to charge you appropriately and they're going to do what it takes to accomplish running that business, right?
Yep.
They're not really caring about how many hours they spend on that property. In this situation, one of the bigger things that we need to make sure we do is put that in writing, documentation in contract saying, hey, here's what I'm trying to accomplish. Here's what I want from you. Here's how we're maybe breaking up some of these duties. I want you to do this. I want me to do this. And I want to make sure that if you're going to exceed this amount of time per year, I need to know about it. Because if I don't, I have no way of beating you
Right.
to the total number of hours, you know?
Right. Yep. So as long as you've got clear documentation and you can have them prove within the contract, within your agreement with them, maybe you're breaking down exactly what responsibilities that entails to you. Because maybe in order to hit the 100 hours, you need to take some of those responsibilities.
Sure.
So maybe they handle just a portion of the management where they're handling kind of the 2 o'clock calls, right, that are coming in. They're handling kind of they're putting out the fires, but you can go ahead and manage, the management of marketing that property out on the different various like VRBO, Airbnb, and maybe it's part of, checking in guests and making sure that people are equipped with when they're ready to stay at your place, right? So that's one way, documenting and making sure that things are documented correctly within your agreement with property management and being strategic about that and making sure that that's effective.
Yeah. We've written down our plan.
The other one is, what about cleaners, right? And this is probably actually the biggest one for most people because they're thinking, well, after every single guest, whether they stayed there a day or 2 weeks, my cleaner's coming in and spending 3-4 hours on the property to get things clean. That adds up really, really quick. Well, one of the easiest ways that we think you could implement a way to track the time is go get a Ring doorbell. Get a Ring doorbell, throw it on the property, have your cleaner ring that doorbell every time they come to clean the property, state their name, who they are, okay, and then say what they're there for, right? And then have them ring that doorbell again when they leave. That's a very easy way, and it timestamps the amount of time that was spent doing that. And so it's like, okay, now I get a timestamp of the cleaners. I get who that individual was. And if I log that correctly, there are ways to kind of be efficient about that, right? But you could manually just log those timestamps in the individual into an Excel spreadsheet, and you can keep track of people's hours. So whether it was a contractor, whether it was a cleaner, doesn't matter. That's your way of tracking their hours. That's your way of tracking who is going into the property and materially participating. That's a really easy way to kind of keep track of that. And when you do that, you're eliminating kind of most of your burden of proof, saying, hey, the cleaners were here for 3 hours that day. No, you get like an exact timestamp to give
Hmm.
to, I mean, you could fork over those video recordings to the IRS
Yeah,
if they
yeah.
come after it too.
Yeah.
So you're just prepared. And that's our big thing is when we run strategies that help clients reduce their their adjusted gross income by hundreds of thousands of dollars, the IRS is going to at least raise an eyebrow at it, and we need to not pray that you don't get audited. We need to do everything so that we're prepared for if you get audited.
Right, right, right.
That's the biggest thing. So you need to learn these rules. It's not always on the job of your CPA. It's not always on the job of whoever's you're consulting with to understand it completely. You're the one that has to implement it.
Hmm.
Right? I can't implement it for you. I can't materially participate for you. And so you need to know what is material participation. You need to know the requirements around documenting that time and logging it. And when you can do that efficiently, you can sleep well. You can sleep good at night, knowing that you've checked all the boxes that the IRS it needs you to check.
Yep.
Right.
Yep.
Perfect. Well, let's go into why is this so powerful. Obviously, we just gave you a breakdown of what it is, who this is for, some tips and tricks on how to actually work this out in real life, and some of the hurdles that you might face. What makes this so powerful? Matt, you want to take that?
Yeah, absolutely. So the biggest part of this, and kind of the reason people run this strategy, is it reduces your adjusted gross income. It reduces your income that is on paper that is taxable, and that's the biggest power, right? So if you are a high income earner that has active job that is earning a lot of money and has a big tax bill at the end of the year, whatever we can do to reduce your adjusted gross income is going to benefit us, right? So we have the 401ks and the IRAs, whatever retirement accounts that we've put into the health savings accounts, all these things that reduce your adjusted gross income. But at the end of the day, there's people that out earn that, and that still end up in some of these higher tax brackets where you're paying 37% federal tax rate at the high end, plus additional taxes, whether it's Medicare or self-employment tax or state taxes. We're not going to get into all those; it varies by state, anyways. But just on the federal side, 37% tax bracket for some of that.
Yeah.
The benefit of this is that if you employ a strategy like this, if you put this together and you're able to put it to work for you, having a 37% discount on that investment is pretty massive, right? So if you were to pay, let's say you buy a property for 1.2 million, right? The building itself, you can't depreciate land. So the building itself, let's say, is $1 million. If I put 200,000 into that property, 250,000 down as a down payment. Let's say maybe in that first year, after we run this cost segregation study and after we do take our accelerated depreciation, we're able to come back and depreciate an additional $200,000 that year. If I'm making $500,000 in my W-2 job and I reduce my adjusted gross income by $200,000, my savings on my tax bill at 37% tax rate, my savings on the tax bill ends up being around $74,000. So what do I do with that? I have that $74,000 that the IRS has said, all right, well, here's a voucher. You don't have to pay us the tax on that now. This is a tax shelter. It's not getting rid of the tax altogether. But as long as you own that property, you don't have to pay the taxes on that money that you depreciated, right? They're saying, hey, go ahead and hold on to this for now. You'll pay us later when you sell the house, right? Instead of just buying a boat or whatever with that, the option that I could do is to take that money and reinvest that, continue to snowball that into another property. And so 3 years down the road, I've ran this exact thing. I've ran the exact process. I've spent $200,000, $250,000. I depreciate down. I save $74,000. I basically end up getting a buy three, get one free sort of discount on investments, right? So getting a 37% discount on an investment on the money you put down is massive.
Yeah.
It's huge. The effects that that can have on you 5 years from now, 10 years from now, when you've employed this strategy, you've taken that savings and you've reinvested that. You've continued to build your wealth in a cash flowing group of assets, right? You have multiple homes at that point that are cash flowing for you regularly. They don't have to stay a short-term rental. We can convert them to a different type of rental as well. We can go long-term with it down the road potentially.
Yeah.
We can group some of these activities so that we're able to materially participate into the group of assets instead of just each individual one, which can get tricky. So there's things that we can do to make sure that we are efficient in the whole process. But at the end of the day, if we're snowballing all of that wealth into more assets that continue to cash flow for us, that continue to appreciate for us, that continue to allow depreciation for us, that tenants are paying down the mortgage on,
Yep.
it's money that's being set aside and it's kind of locked up there for a little bit. But what happens down the road when I have an asset that's now worth 50% more than it was 10 years ago? I can borrow against that asset, right? I have a leveraged investment here that I can now borrow against that property. The money I bring in that borrowing, in that loan or the HELOC, whatever it is, whatever form I'm pulling that out in,
Tax free.
it's tax
a loan.
free. It's not taxed. It's not income. It's a loan against a property, right? So the ability to snowball this is massive. It's a really good strategy for people to use.
Yeah, you're no longer this. This really is a good play to get out of the rat trap of keeping up with the Joneses. You become the Joneses.
Yeah.
When you implement a strategy like this, you get out of that mindset and you say, okay, when I compare myself to somebody making the same income, right, over the next 10 years, 5 years, 3 years, you're going to see a drastic difference in your wealth accumulation because of that snowball effect that Matt just talked about.
Yeah, absolutely.
So that's our plug today is don't stop keeping up with the Joneses, become the Joneses. Do what the Joneses do, right? So yeah, that's a high level view of what the short-term rental, the STR loophole strategy is, how you can use it to take active losses against active income. Beware of those hurdles. Beware of the hurdles in real life and how to actually implement this strategy well and correctly. Consult with your CPA around that and actually come up with a really good plan. One way that we help clients is we do one-on-one consults, and we have a real estate team to help you identify and actually find the properties that are valuable for a strategy like this. So we do one-on-one consulting around not just this strategy, but all sorts of tax-savvy real estate strategies that can help you depending on your scenario. And so the easiest way to get in touch with us is we are real people. We are on our LinkedIns. We don't have other people running our LinkedIns, which is kind of a common thing we find for most people. It's funny. But just DM us, comment on this video, DM us. If you've got a question, just let us know, and we'll be more than happy to go ahead and jump into a conversation with you around what might make sense for you and maybe break down a strategy. And maybe there's a good opportunity for us to work together and put together a specialized and personalized plan for you. So would love to do that. Thanks for watching this video all the way through. And we hope to catch you on the next one.